Supermicrocomputer Inc. closed its last trading session on Thursday, July 2, 2026, at exactly $27.22, marking a decline of 1.56% for the day on a heavy trading volume of over 42 million shares. The stock market is officially closed today, Friday, July 3, 2026, in observance of the Independence Day holiday, leaving investors to ponder a dramatic disconnect that has recently reshaped this technology giant. While the standard retail narrative suggests this company is merely experiencing a temporary soft patch alongside broader market volatility, the reality hiding beneath the surface is far more complex. The company recently completed a massive $7 billion capital raise that has severely diluted existing shareholders, all while dealing with a fresh regulatory shockwave after Taiwanese authorities conducted a surprise raid on their local branch office just days ago. This creates a fascinating dynamic where the business itself is growing at triple-digit speeds, yet the structural foundation is experiencing unprecedented stress that has caused the valuation to decouple from its traditional technology peers. When you look at the broader landscape of modern tech investments, the general expectation among the public is that any hardware developer closely aligned with Nvidia stock or producing high-end server architecture is a guaranteed winner. People open up a Robinhood app or log into their individual brokerage accounts expecting to see aggressive premiums assigned to companies that supply the data centers powering modern computing. The prevailing belief is that as long as corporate giants keep buying server racks, the stock price should inevitably climb. However, the underlying reality presents a sharp contradiction to this simple thesis. While companies like Dell and HPE trade at significantly higher multiples, Supermicrocomputer Inc. has seen its forward price-to-earnings ratio compressed to a mere 9.5 times. This massive valuation discount exists because the market is explicitly pricing in a heavy risk premium due to a persistent Department of Justice investigation and ongoing corporate governance concerns, rather than simply evaluating the raw demand for server racks. For anyone managing their own capital through self-investing or looking for investment help on popular investing sites, this stock has become one of the most polarizing setups in the current market. Traders utilizing the Robinhood mobile app for active speculation have watched the stock establish a critical line, testing a potential double bottom formation between $27.72 and $28.66. Technical analysts tracking the relative strength index see it hovering around a neutral 42, indicating that while the selling pressure has been relentless, the stock is not yet technically oversold. If you are tracking your portfolio via SoFi Invest or managing long-term wealth through Fidelity Investments, the contrast between the business execution and the headline risk is staggering. The core dilemma is whether this massive markdown represents a generational value opportunity or a classic structural trap designed to catch retail investors off guard. To understand how we arrived at this point, we have to look closely at the institutional activity and the flow of capital across major platforms like Interactive Brokers. Wealth managers overseeing accounts within Schwab Intelligent Portfolios or distributing assets into diversified vehicles like Fidelity ETFs and Fidelity Mutual Funds have pulled back their aggressive allocations to protect against sudden regulatory announcements. The massive $7 billion capital raise executed earlier this year was intended to fund a staggering $39 billion order backlog from over 20 major corporate clients, but the resulting dilution has placed a heavy ceiling on near-term per-share appreciation. When an investor decides to invest online or buy individual equities through a comprehensive individual brokerage account, they must weigh this equity dilution against the sheer volume of products moving out of the assembly facilities. The story of the business model itself is rooted in high-performance server solutions, specifically optimized for liquid-cooled data architecture and massive cluster deployments. Unlike standard hardware providers that offer slow, generalized computing configurations, this organization built its reputation on what they call data center building block solutions. This allows corporate buyers to rapidly customize their infrastructure using modular components, which drastically cuts down deployment times during capital expenditure cycles. This operational flexibility is the exact reason why their fiscal third quarter revenue surged by 123% year over year to reach $10.2 billion. Yet even that astronomical growth figure managed to miss the consensus Wall Street projection of $12.3 billion, highlighting the intense pressure the company faces to meet heightened market expectations. If you are using a modern online platform such as SoFi Invest or executing institutional orders via the Interactive Brokers trading platform, the primary operational metric to watch right now is gross margin. The trailing 12-month gross margin has hovered at a razor-thin 8.4%, which offers very little breathing room for a company scaling its physical manufacturing capacity at this speed. Long-term wealth management strategists using Fidelity brokerage services or looking at historical trends through Fidelity IRAs often point out that hypergrowth means very little if it cannot be converted into meaningful net income per share. Management has publicly stated they're actively working to transition toward margin-accretive products as they head toward the end of the calendar year, hoping that their liquid cooling technology will command higher pricing power as data centers become more energy-dense. Let us pause for a moment to gauge where the community stands on this asset. Go ahead and comment below how many shares of Supermicro Computer Inc. you currently hold in your portfolio, and let me know if you are buying this dip or waiting for full legal clarity. It's always interesting to see how retail positioning matches up against the institutional flows we see on the major exchanges. Looking at the tactical horizon, the upcoming fiscal fourth quarter earnings release scheduled for early August 2026 is shaping up to be the ultimate turning point for the stock. If the financial reports show a clear structural shift toward double-digit gross margins, it will provide powerful validation for the bullish thesis, suggesting that the underlying demand engine can easily outrun the operational headwinds. On the flip side, if margins contract further toward 8%, it will hand the short sellers definitive proof that the business lacks structural pricing leverage. For individuals who prefer an automated approach through an intelligent portfolio or execute manual trades on the Robinhood stock trading system, the immediate future requires looking past the daily noise and focusing purely on whether the company can maintain its relationship with primary semiconductor suppliers. When we look at the relative valuation landscape, the discrepancy between this firm and its direct competitors is impossible to ignore. Trading at roughly 0.53 times its next 12 months enterprise value to revenue, the stock appears remarkably cheap when compared to Dell trading near 1.68 times or HPE near 1.54 times. This structural discount is the direct consequence of the legal cloud, including the unsealing of federal indictments against specific individuals and the recent asset disruption in Taiwan. For retail participants utilizing SoFi Active Investing or tracking market movements through the Fidelity mobile app, this creates a profound psychological tension between the expectation of an explosive technology rebound and the reality of a complex legal landscape that could take quarters, if not years, to fully resolve. For investors who approach the market through the lens of online investing or manage their retirement accounts via a dedicated Fidelity trading platform, the lesson here is one of risk management and position sizing. A stock that exhibits such extreme divergence between its operational performance and its regulatory environment cannot be treated like a stable utility or a legacy blue-chip asset. Whether you are buying fractional shares on the Robinhood app, purchasing fixed income instruments, or exploring global markets through an Interactive Brokers account, the key to surviving volatile cycles is understanding exactly what premium you are paying for growth and what discount you are demanding for structural uncertainty. The central insight that emerges from a deep examination of Supermicro Computer Inc. is that the market rarely misprices pure demand, but it will ruthlessly discount structural ambiguity. The popular narrative expected this enterprise to march steadily higher alongside the broader semiconductor boom, riding the coattails of major chips like Tesla stock or Apple stock in a generalized rising tide. The reality, however, has forced a severe correction, reminding everyone that internal governance, margin stability, and regulatory clean sheets are just as important as top-line revenue growth. As the market rests during this holiday closure, the strategic focus remains entirely on the upcoming August parameters, where the hard numbers will finally decide whether the current price represents an overlooked value play or a justified reflection of structural risk.